Hello and welcome to the Saltydog Investor. Whether you like it or not, you can no longer do nothing and expect your investments to flourish. In the next few minutes we'll look at how stock markets have performed over the last 50 years. I'll show you how the assumptions that were true in the past no longer hold water, and why the financial service sector seem unwilling and unable to help. I'll demonstrate that there is something that you can do about it, and hopefully persuade you to become an active investor. First, I'd like to debunk some common myths. If you've ever been sold a savings product investing in the stock market, then I'm pretty sure that you will have been told that over the long term, equity markets have outperformed all other investments. Another way the industry like to put it is it's not timing the market, it's time in the market. Basically, what they're trying to tell you is that if you invest with them, then there may be some ups and downs, but in the long run, you'll be okay. This may have been the case in the past, but does not appear to be the case now. To demonstrate this, let's look at the FTSE All-Share Index from when it started in 1962. There are other indices that you may look at, but most of them have been recalibrated at some point, and so don't go back far enough. The first thing that stands out is from the beginning of the graph through until Black Monday in October 1987, the overall trend was up. In fact, the value of the index had gone up over tenfold in this time. Add in the dividends, and you'd have been unlucky not to see growth in your investments during this period. Let's just stop for a minute and think what else was happening around then. In 1984, the government started its programme of privatisation by denationalising British Telecom. This was followed by the sale of British Airways, Rolls-Royce and British Steel. In 1986, the introduction of PEPs was announced for the following year, and then in 1988 personal pension plans were launched. Investing was no longer the preserve of an elite few. It was suddenly available to everyone. We were all being told to take control of our financial future, and the implication was that it was easy. If you want real long-term growth, go for equity-based investments. The crash of 1987 didn't help, but for many this was seen as an opportunity to jump aboard the boat to financial freedom, but with a discounted ticket. Sure enough, the markets recovered, and although they had a significant but short-lived collapse in 1998, when the Russian government defaulted on its debts and devalued the ruble, the overall trend was growth, and growth at a staggering rate. In a minute, we'll look at what happened from 2000 onwards. But first, to recap. From after the Second World War until 1999, the index had gone up over 30-fold. We were all being actively encouraged to invest in the equity markets, and the whole industry had been spawned to service the need. But then what happened? The tech bubble burst, and stock markets almost halved in value. Then we saw a dramatic recovery, led by the housing boom that was financed by cheap credit, that eventually led to the credit crunch of 2007-08, the consequences of which are still haunting us today. Over the last dozen years it can be seen that the markets have been much more volatile, and the assumption that they will keep going up forever has been proved to be untrue. Investing during the last 10 years has been more challenging than we have seen for a whole generation, and we're not the only people who have noticed. In 2010, the Sunday Times reported that £14 billion was invested in pension funds that have failed to beat inflation over the last 10 years. And then in 2011, Best Invest reported that £23 billion was invested in underperforming funds. It then went on to remind us that these same funds had paid out nearly £350 million in fees to managers and advisors every year. If it's so obvious, why haven't the financial services industry been drawing our attention to it and suggesting we do something about it? The world has changed and they have not changed with it. The key to making money in funds is not to simply invest and leave your money there forever. That's what most advisors and fund managers would have you believe. Why? As you would imagine, it's because it suits them. That way they can keep your money through thick and thin and keep charging you for not managing it. To be fair on them, the current charging structure does not enable IFAs or other pension advisors to dedicate enough time to each customer to provide a bespoke service. Remember that most of these products were developed in the 1980s, when it was assumed that stock markets would keep going up forever. We now know that's not true. And finally, there's very little incentive for your advisors to actively manage your investments. They get paid regardless of performance. In 2006, the Financial Services Authority created its Retail Distribution Review Programme to be implemented by the end of 2012. This will change the way IFAs are remunerated, and unless you have significant funds under management, you are likely to receive less advice rather than more. This inevitably leads to the question, what can you do about it? On a more positive note, there have been significant changes over the years that have made it easier for you to get actively involved in managing your investments. For example, did you know that you can switch funds within an ISA without losing the tax benefits? You'd be surprised how many people have never changed the funds in their ISAs and yet moan about their dismal performance. Most pension plans have access to a selection of funds, and the number of funds available is increasing and the costs of switching are coming down. If you haven't recently reviewed which funds you're invested in and what else is available, then contact your pension provider and get up to speed. If you're comfortable making your own fund choices and choose to operate through a fund supermarket, then you may be able to switch between thousands of funds at no or very low costs. What do we mean by being active? When we talk about being active, we mean being in the right funds, in the right sectors, at the right times. We like to think about going up the investment ladders without then sliding down the snakes. If you look at the recent swings in the FTSE 100, then from the end of December 1999 through to March 2003, it dropped 50%. In the next 4.5 years it recovered over 93%, only to fall another 48% between October 2007 and March 2009. It then staged another partial recovery, going up 72% up until April 2011, but between then and October 2011 had dropped another 11%. The net effect was that in the 10 years to October 2011, the FTSE 100 had risen 3%. During that time there had been two major collapses. If you're trying getting out of the markets when they had fallen 10% from their highs and then reinvested 10% from the bottom, then you could have seen growth of 150%. From an investor's perspective, there are dividends to add into this, but the argument is still just as valid. Of course, people will tell you that it's easier said than done, but that's no excuse for not trying. So where does the Saltydog investor fit in? We only look at unit trusts and open-ended investment companies. We are not a get-rich-quick scheme, and neither are we financed by the industry. What we do is provide unique data presented in an easy-to-use format. It's up-to-date, focusing on the last few weeks and months, and not the industry standards of 1, 3 and 5 years. We analyse over 24,000 funds and show which of the readily available ones are performing well at the moment. We look at the relative performance of different sectors to help identify which areas are ripe for investment and which have gone off the boil. We recognise the importance of portfolio management and combine the sectors into our easy-to-understand Saltydog groups: Safe Haven, Slow Ahead, Steady as She Goes and Full Steam Ahead. We can then monitor the relative performance of the groups to help people reposition their investments to suit the prevailing market conditions. It's all well and good explaining the principles, but there's nothing like demonstrating it. That's why in November 2010 we invested £40,000 in a portfolio of funds that we have managed based on the data that we provide to our subscribers. During the first year we outperformed over 95% of the individual funds that we analyse, and the portfolio gained over 7%. This is in a year when the FTSE 100 dropped nearly 8%. To find out more about how we sort, group and rank the funds to help you make more informed investment decisions, or just to give you the confidence to talk knowledgeably to your current advisor, go to our website www.saltydoginvestor.com and sign up for our free 2-month trial.